The ultimate Dividend Aristocrat tier list. What is happening, investors? It is your boy Jack. I am not a financial advisor. I got the hoodie to prove it, people. And today we're going to be speaking and ranking some Dividend Aristocrats. For those of you who aren't aware of what a Dividend Aristocrat actually is, they are S&P 500 companies who have raised their dividend payout consecutively every year for more than 25 years. Now, there is another subsection of dividend stocks called Dividend Kings, and they are S&P 500 companies who have increased their payout for more than 50 years. And I have already made a video on those companies, so I'm not going to include any of them today. So the 10 companies we're going to speak about today will have increased their payout for 25 to 49 years, absolute maximum. These companies are absolutely loved by dividend investors all across the world for multiple reasons. The last thing you want as a dividend investor is for your dividend payout to be cut or completely eliminated. So Dividend Aristocrats are attractive. If you haven't seen one of these videos before, we're going to be ranking 10 different companies on a scale from super amazing all the way down to stay away. So right before we get into looking into all 10 of the companies, can I please ask you to smash a like on this video, as it really helps me and the channel out so much. Once you've watched this video, drop me a comment down below. Let me know what you think. If there's anything you disagree with, you would change on the tier list, or any tier list videos you'd like to see me make in the future. And of course, please hit that juicy red subscribe button and join the family, people. We smashed through 15,000 subs a few days ago. The road to 20,000 is well and truly on. I appreciate you all so much yet again. With all that being said, let's get straight into the video. So a quick look at the 10 companies we're going to be having a look at today. We have Caterpillar, Chevron, Consolidated, Edison, McDonald's, Pepsi, Realty Corp, AT&T, Walgreens, Walmart, and Exxon Mobil. Now, quite obviously, we're looking through 10 companies. I'm only going to briefly touch off each one, but let's not waste any time. Our first company of today, Caterpillar. So a very popular company, more than likely one that you're all familiar with. They design, develop, engineer, manufacture, market, and sell machinery, engines, and financial products and insurance to customers via a worldwide dealer network. So Caterpillar has a dividend streak of 27 plus years, and we can see that they currently have a dividend yield of about 3%, so a very respectable dividend yield. And on the 6-month chart, they are actually doing quite well. They're up 1.36%, and considering the industry that they're in, that is very good. And with that in mind, they're still only trading at a PE ratio of 14.57. Now, I am going to try rate these companies as fairly as possible based on the fact that, they're primarily going to be for dividend investors, not growth investors. But of course, we do still have to look historically at the returns these stocks have seen, because you don't want your dividend investments to go down in value just because they pay a dividend. So on the 5-year chart, we can see they had a nice little run, a decent run, okay? Pre-crash, they were looking in a decent position. But now, as of this moment in time on the 5-year chart, they're up about 75%, which, for a company with a 3% dividend, given the times we're in right now, is actually quite decent, people. And on the max stock chart, we can see that last time, coming out of the Great Recession, they went on a really nice run. So when times are doing economically well, a company like Caterpillar is probably going to do well, and when they're doing poor, they're going to do poor. Now, even pre-crash, they were downtrending since the very start of 2018, so that is something to keep in mind as well. Now, some of their ratios aren't the most attractive in the whole wide world, like their net debt to capital being at 42%, and their forward PE ratio being at a massive 80%. And being that the industrial sectors, the future of it is quite uncertain at this stage of time. We don't know when everything will be back to normal. There are some short-term risks associated with this company, to say the least. But ultimately, as far as a dividend investment paying company goes, I think they're quite good. So that's exactly where I'll throw them. Quite good. And coming off the back of Caterpillar, we rather appropriately go on to Chevron. So not as good a performance on the 6-month chart. Chevron is actually down over 18%. Chevron do, however, have a massive dividend yield of 5.73% and a PE ratio currently of 44.64. And with this company, we go back to the 5-year chart, and there was some slow but steady growth on the 5-year chart. Okay, 5 years pre-crash, up about 35.26%, but again, 5.73% dividend yield. Now, Chevron has a 33-year dividend streak. They have a very high payout ratio. They cannot have a forward payout ratio right now because analysts actually project a loss over the next year, but their balance sheet is in a great place with their net debt to capital only being at 17%. So again, the fact they have that dividend of 33 plus years would lead you to believe they're going to ultimately be able to keep paying it. If we do go over to the balance sheet, we can see cash and cash equivalents, nearly 8.5 billion in cash, current assets at 28.5 billion, total assets 236.6 billion, current liabilities 28.2 billion, and total liabilities 91.7 billion. So they're fine. In the short term, they're pretty much balanced out. In the long term, they're in quite a nice position. Now, they are in oil as well, so a very uncertain industry at the moment. And the fact they have that very high dividend yield, I don't think it's going to help them over the next year or two. And so I do think it's going to be quite a slow year or two, to say the least. In 3 months, they've moved, nearly exactly sideways. It's been not a lot of movement whatsoever. I think in time, Chevron could definitely be a really good dividend paying company. And, I'm not worried about them having to cut their dividend or anything like that, in all honesty. I do just think that the short-term future prospects of them is really uncertain right now. Despite the fact they have a very nice dividend, I will actually put them into mid-tier just because, again, a lot of the time dividend investors, they want safe companies, you don't want to have to be worrying about them too much. And Chevron right now definitely has its risks. Okay, next up, Consolidated, Edison. So these guys are quite an interesting company, okay? 6-month chart looks really weird, but ultimately they are down close to 20%. Current PE ratio is at 19.44 with a market cap of 25 billion and a dividend yield of 4.05%. So, a lot of dividend investors look for that 3.5 to 4% dividend yield. This falls right in that range. The 5-year chart up 18.86%. Now, pre-crash, they were up 48.29%. So, somewhat underperformed as a dividend paying company, but not terribly by any means whatsoever. And on the max stock chart, we can see that over time there has been some really nice steady growth in this company with not too many major down periods. Now this dividend has been growing very, very slowly as of late, so I wouldn't expect to be getting much more than 4% out of it anytime soon. Payout ratio is 69%, which for utilities is absolutely fine. Forward payout ratio as well, so that dividend's looking very, very safe, and the company as a whole is looking safe. Net debt to capital is not terrible, and they have a dividend streak of 46 plus years. And if we go over to the balance sheet, right, we see current assets of 5 billion. We see total assets 59.15 billion. Current liabilities 6.3 billion and total liabilities 40.6 billion. So definitely from a long-term point of view, in a fine place. Now again, as a dividend paying company, okay, if you're investing in this company purely with the understanding that, it'll grow slowly but surely over time and you are going to get your 4+% dividend, I actually think it's a very good company. If it had better growth prospects as well, then it would definitely be getting ranked a little bit higher. But for me, I think it's a very safe choice and I would put it up into quite good. I would be on the verge of putting it into amazing, but it's just that when we look at the last 20 years of growth, it's only returned 167%. Now I know that's by no means bad, but it's nothing fantastic over the span of 20 years. It is hard to rate dividend companies because there's different kinds of dividend investors. Some people just want to invest and live off their dividends and don't really care about growth. And if that's the case, you could genuinely put Con Edison into amazing or super amazing because it is very safe. But if you are younger and you want some sort of growth and dividends, it's going to have to go around the quite good mark. Okay, next up we're going to have a company that absolutely everybody is going to be aware of, McDonald's. So first of all, on the 6-month chart, down 5%. It's been decent, all things considered, because McDonald's would have been hit very, very hard. They had to completely close down the majority of their world restaurants at one stage or another all over the world. Market cap nearly 150 billion, PE ratio of about 26, and a dividend yield of 2.5%. So not the biggest dividend yield in the world, but a decent one nonetheless. And when we look at the growth of McDonald's, it far outperforms an awful lot of other dividend aristocrats, okay? So 5 years before the crash, up 117%, okay? As of right now, still up 99%. That's very good growth for a dividend paying company. And on the max stock chart again, we can see that, well, for the last 18 years anyway, there has just been immense growth. And I mean really, really, really good growth, especially for a dividend paying company. They've also been paying that dividend for 45 plus years, so approaching that dividend king status. And one thing I want to say about McDonald's that not a lot of people speak about is the fact that a lot of their assets come from their real estate. McDonald's owns the land on which all of their McDonald's buildings are built. And you can see that in their long-term assets. Their net property, plant and equipment is what makes up most of their total assets. While we're having a look at the balance sheet, current assets 7.5 billion, okay, total assets 50.5 billion, current liabilities just shy of 4 billion, and total liabilities 59.8 billion. So not the best in the whole wide world, but not particularly bad whatsoever. And I mean, it is McDonald's. So during the recession, very good, okay? Recession sales were only down 5.8% and the recession return was only down 3%. That is incredible. The S&P 500 was down 55%. So the payout ratio is at 63%, a little bit higher than where we'd like it to be. And the forward payout ratio was at 83%. But given the world we live in, we have to forgive them for that. Now, this company is growing the dividend very, very quickly, okay? 17% average per year for the last 20 years. So their growth has been absolutely fantastic. They're one of the biggest brands in the whole world. Everybody knows who McDonald's are. Their dividend yield's at 2.5% and is being grown absolutely massively quickly. There most definitely will be a stage where this is a 3.5 to 4% dividend yield. They've shown what they can do time and time again. To me, I really like McDonald's as a company. It is a dividend company that I'm actually invested in, and I'm not in very many anymore. I'm going to put them up into amazing because, again, that growth has been incredible, guys, and the dividend growth has been incredible. Okay, next up we have Pepsi, which is actually another one of my personal favorite dividend paying companies. So Pepsi on the 6-month chart down 4.28%. average, okay? Dividend yield 3%, market cap 188 billion, and PE ratio of 27.79. 5-year growth, okay, quite slow, 41%, and even before the crash it was only at 52%. Now, this does fall in line with average. You know, a lot of dividend investors will look for 10 to 15% per year growth before the dividend yield, so it's right about average. Now, if we do go back to just more than 10 years ago, again, it stands true, 123% in 10 years. Very average growth, very consistent growth, but very average. Current assets 23.1 billion, okay? Total assets 89.5 billion. Current liabilities 23.8 billion, total liabilities 76.9 billion. It's a fine balance sheet. Now they're still growing their dividend at quite a nice rate as well. 10% a year on average the last 20 years, and it's already at 3%. That's a good sign. And they're also approaching dividend king status with a dividend streak of 48 plus years right now. Now, as a dividend paying company, if you're one of those people, like I said earlier on in the video, who just wants to invest in a company who you think the dividend is really safe and who won't ever lose value, I personally would have to put them up into amazing because I think it's really good. And if they had a 4+% dividend, they'd go up into super amazing. As of right now though, I just think there's better options. The growth has been dead on average, you know, there's nothing really special. The dividend yield's average, the growth's average. I'm going to put them into quite good, okay, because I do like them as a company and I do actually own a position in them, but it's a very small one. I can definitely see though why people would put this into amazing. I would be this close to doing so. It's just if the growth was a little bit better. They do have good growth prospects in my opinion, but as of right now, what they've shown, I'm going to put them into quite good. Okay, we have 5 companies left. Realty Income Corp and REIT. Interesting company, okay? 6-month chart. We are still down 25%. Dividend yield of just shy of 5%. Market cap of less than 20 billion. PE ratio of just under 40. 5-year chart, okay? Pre-crash, we were up about 66%. So slightly above average, but still just about that average mark. Max stock chart, another company who we just see very, very slow and steady growth with. Again, if we go on the 10-year chart pre-crash, nearly 200%, which to be fair is very good. And they do have that big dividend yield. Now these guys are very new to being a dividend aristocrat, okay? They just about got it this year. Assets 18.8 billion, liabilities 8.3 billion. So nice position on the balance sheet. They do have a 15.3% compound average annual total return since 1994. Now that does sound good, and of course it is good, but it's by no means anything special. And the other thing I want to do is go through their top 20 tenants. Well, I don't want to, but look at some of the names. We've Walgreens, 7-Eleven, Dollar General, okay? There's a lot of stores in there. And a lot of the world is slowly but surely moving online. E-commerce is a very, very quickly growing industry. And one of my worries with a company like this, and again, I have a small position in Realty Income. It's a very small position, but it's a position nonetheless. But the reason I have been reluctant to add more to this position is because of this. Because I naturally am such a bull on e-commerce. I'm a bull in believing that a lot of the world is going to move online. And there may not be as many physical store locations in the future as there has been in the past. And something like this would obviously very much so negatively affect Realty Income. It's not like all physical stores in the world are going to disappear. There's always going to be need for a company like Realty Income. I was fortunate enough to get them down around here, $49 a share, and you know, I saw some nice growth, okay? I was up around 25% in my position, but since then, it has given back a bit of that growth. I think as a dividend paying company, if you get into them at a decent price, it's a good investment, but you may not be able to just hold on to them forever, which is what people like to do with their dividend companies. Again, it's a tough one. I'm going to have to put them into quite good. Why is everything just going into quite good? And why does this look like a very questionable shape? 4 more companies. Next up, one everybody's aware of, AT&T. Now, AT&T is a company who has had a tough couple of years, primarily down to a few poor mergers. You can see that if we look in the 5-year chart, okay? From 2016, it was downtrading all the way through to 2019, down 33%. In 2019, we started to make a nice run back up, and a very nice run back up, okay? Then we go back to the 6-month chart, and there was a crash, a big crash, and they're still trading down about 23.35%. AT&T currently has a dividend yield of 7%, okay? A PE ratio of 80 and a market cap of over 200 billion. The biggest telecommunications company that there is out there. There is huge growth prospects, 5G being one of them. They've been paying that dividend for 36 plus years, and despite the fact it's at 7%, they only have a 59% payout ratio, and even a 67% forward payout ratio. Given the times we're in, that's not bad at all. And as well, net debt to capital 48%. Now, for me, one of the big reasons I'm bullish on T is actually because of the growth prospects. I think there is a lot of room for some really big growth in a company like AT&T in the long term. It might be weird to say that considering we could see that very clear downtrend for a considerable period of time, but that is how I feel about them. Again, this is a company I am invested in, and I'm invested in them more so than most of my other dividend companies. It's a 7% dividend, okay? The payout ratio is quite low. The growth prospects are big. They've been hit particularly hard over the last couple of years, and then furthermore given by this situation. I personally am going to be putting them into amazing, okay? There are the risks associated with them. And again, if you're one of the more conservative dividend investors, bring that down to quite good, or even bring it down to mid-tier, because they do have more risks than a lot of the safer companies, but for me personally, they're going into amazing. Okay, Walgreens, a little bit of an interesting one that we don't really speak about very often. 6-month chart still down 22%. Now, dividend yield is very nice, 4.62%. PE ratio, very high, okay, 50. Market cap is only at $35 billion as well. 5-year chart, guys. It's been nothing but downwards movement, down 58% on the 5-year chart. Net debt to capital at 66%, which is high for consumer retails, okay? Net debt to EBITDA is high. Their payout ratios are somewhat high for consumer retailers. The dividend has been growing very quickly, which is a very good thing, but what's the point in a good dividend if in the last 5 years the company's gone down well over 50% in value? Current assets 18.3 billion, total assets 86.4 billion, current liabilities 26.6 billion, total liabilities 65.12 billion. So in the short term, especially given the times we're living in, not a great position. Long term, it's okay. But I mean, they're a retail pharmacy, guys. It's not exactly like there's any immense growth opportunities here. Given the last 5 years, guys, no, I don't like it at all. At this moment in time, I would have to put them in to stay away. At this moment in time, after coming down so much in 5 years and still having such an incredibly high PE ratio and being in a struggling position in the short term, given the times we live in right now, I would see no reason I personally would want to invest in this company. Now, someday in the future, if they, get their act together, if they start to see some decent growth, they could definitely move up the ranking. But right now, I'm staying away. Not a chance I'm touching off them. Walmart, very interesting one. In the last month, Walmart's seen some really nice growth. May remember this is because of their same day or next day delivery that people were saying is going to counter Amazon, which I don't think it will whatsoever. 6-month chart. Growth up 13.27%. 5-year chart is pretty much nothing but growth, a total of 82.3% as well, which is quite nice. And the max stock chart, look, it was very sideways for a long time. There's no denying it. Very sideways. Then there was some nice growth, then a dip, and then in the last 5 years is really when we've started seeing any sort of growth whatsoever. Now, from the start, it only has a dividend yield of 1.65%. For a dividend investor, that, simply put, is not enough. I mean, you can get away with 2.5%, 3%, but 1.65% is very, very low. Now, with that being said, the last 5 years there's been some very nice growth, but everything before those last 5 years, there wasn't really very much special going on at all. Current assets, 63.3 billion. Total assets, 232.8 billion. Current liabilities, 82.6 billion. Okay, not fantastic. And then total liabilities, 158.7 billion. So, not the best balance sheet in the world, in the short term at least, but it's fine. Again, payout ratios are quite high, low net debt to EBITDA, and net debt to capital is a little bit high. 47 plus year dividend streak, but again, 47 years with a 1.65% yield, not ideal. And they are somewhat of a defensive investment, recession sales and recession return, way better than the global market. Now for me, guys, I actually do think Walmart, as far as a retail investment, is a very good investment to make. From the eyes of a dividend investor though, 1.65%, simply, it just doesn't cut it, guys. If I was ranking them on an investment, I mean, I would be more inclined to invest in Walmart than a lot of these other companies. But if I was getting ready to retire and live off of my dividends, what? 1.65% is terrible. So for that reason, I'm going to put them into mid-tier because the growth has been really good, okay? So for me, that's very important. But 1.65%. Very easily could put them up here. I honestly could put them up here, but I think that's where I have to put them today. And the last one we have, Exxon Mobil. Now I know a lot of you guys are invested in XOM, okay? 6-month chart, ain't looking pretty, boys, okay? We're down 32.92%. Absolutely terrible. 5-year chart doesn't get much better, guys. Doesn't get much better at all. Before the crash, they were down 11.7%. Now do keep in mind, we have an 8% dividend yield, but still, that's terrible. Max stock chart has been really weird. Really shaky, okay? But say, for example, you bought in at the peaks of 2007. Right now, you're down 52.9%. Thing is, okay, I know I'm one of the people who really likes to look for growth. I really am. It's just within me. and I do quite like Exxon. Now, I am a holder of Exxon. Again, relatively small position. I haven't bought any in more than like 2 or 3 months, but I have a small position. Right now, the payout ratio is at 156%. Analysts project a loss over the next year. The net debt to capital is 25%, and the net debt to EBITDA is 2.54. Current assets, 50 billion. Total assets 355 billion. Current liabilities 64.7 billion. Total liabilities 167 billion. The oil industry as a whole, for me, guys, is a really weird one to try and speak about, because if you watch the channel, you'll know I'm massive on EV, okay? And obviously EV is going to take away more than likely from some of the money that companies like Exxon are going to make in the long term. So we can say that, you know, they've hovered around maybe, let's say, anywhere from $100 to $75+ for years. So under normal circumstances, when oil prices go back to normal, when supply and demand is all back to normal, well, you could expect it to somewhat get to that price point, which would make $43 a share with an 8% dividend yield very attractive. I mean, they were at $64 6 months ago. The question is, will things ever return to normal? And if so, how long? Now, although I am a bull on EV, there's going to be a place in the world for oil for a very, 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 very long time. Oil is not disappearing. Right now, though, Exxon's in such an uncertain place. That's why I haven't added to my position, despite the fact that they're still down considerably. And I do realistically believe that they could easily be a $60 to $70 plus company again in the relatively short term. They are one of the most popular dividend stocks out there, no denying it. Everybody knows who they are because of that massive dividend yield of 8%. And despite the fact the payout ratio is ridiculously high right now, I do think it's quite safe from a dividend investor's point of view, okay? Oh, it's tough. As of right now, and the amount of uncertainty there is going forwards, I'd have to put them into mid-tier. Understand, guys, I own this company, okay? For me, I think the growth prospects could be very good, but they do carry quite a lot of risk, which isn't something you want as a dividend investor. And that is it. No super amazing companies, not even any mega companies. Now, we have to put everything into exact order. So if I could only invest in McDonald's or AT&T, I personally would choose McDonald's. For me, I know their growth hasn't been particularly special. I still would put Pepsi there first. I mean, the dividend is decent and I believe it's very, very safe and only going to grow. Then I would put Realty Income, then Con Edison. Now, mid-tier, for me, Exxon Mobil definitely has to go in front here. I do think they're the best by a considerable margin. Then Walmart, then Chevron. Because realistically, Walmart could easily be up here, depending on your values. And then stay away. Sorry, Walgreens, you're the only one. So guys, if you watched until the end, hopefully I was able to give you some sort of value and ultimately you enjoyed the video. That's always the goal with these. It is really hard to rank dividend companies though, because there are different types of investors who invest in these companies for different reasons, and I obviously carry my own biases as somebody who is a young person who primarily looks for, you know, decent growth companies. So you could very easily rearrange that list depending on what style of investor you are, but anyway, that's the way I personally put it. If you did watch until the end, you, my friend, are a true legend. You are what is keeping this channel growing, and I have so much appreciation for you. I can't even describe it, but thank you so much. If you did enjoy the video and you got some sort of value out of it and you haven't yet, please smash that like button and drop me a comment down below. Those two things help me out so much, people. And with that being said, I hope you all have an absolutely fantastic day. I will see you for tomorrow's video. Peace.